So interest rates are on the rise again. The 10-year yield just went from 3.6% to 4% in under a month. Rising interest rates can have absolutely massive implications and are something that nobody should ignore. We just have to rewind to the 1970s to understand that. This is what happened to interest rates between 1972 and 1975. And when we look at the impact that had on the US stock market, it caused one of the largest market crashes of the last 100 years. Now, although the recent jump in interest rates looks small, the big worry is that this is just the beginning of a resumption of the rising interest rates we had throughout 2022. Indeed, if we quickly sketch out the same chart from the 1970s on top of today's interest rates, we definitely see their similarities. And you understand why a lot of people get spooked every time there's a little jump in interest rates. Because if this is what's in front of us, it's going to make the rising interest rates from 2022 look like child's play. In order for us to know whether this scenario is actually plausible, we can start by looking at exactly what happened right here in October of 1973, exactly 51 years ago, that catalyzed the rest of this move up in interest rates. If you know your history, this is the date of the Yom Kippur War, where Egypt and Syria launched an attack on Israel to reclaim the Sinai Peninsula and the Golan Heights. And this conflict led to an Arab oil embargo, significantly reducing the oil supply from a region absolutely key in oil production. In fact, oil prices immediately tripled following the start of the conflict in October of 1973. And oil being one of the most important raw materials of the global economy, this instantly brought about a wave of inflation. And with higher levels of inflation comes higher interest rates, because over the long run, what we see is that interest rates typically follow what inflation does. So that's what triggered the rising interest rates in October of 1973. Oil prices rose as a result of the war in the Middle East, which created a bunch of inflation, which led interest rates higher. Now, if we look at what oil prices have been doing today, we're definitely not in the same situation. Oil prices in October of 2024 are lower than they were in October of 2023. Not really the same type of situation to what we had in 1973. So at a first glance, it doesn't look like we should be too worried about rising interest rates. However, unless you've been living under a rock, you've probably heard that there's been some things happening in the Middle East. Things that could potentially cause the price of oil to rise if, let's say, an all-out war starts in a region that is responsible for 50% of the world's oil production. In fact, if we look at oil's price a little bit closer, we see there was a little bit of a jump right here as a result of an escalation of the conflict. And when we add the 10-year interest rate on top of the price of oil, we see that the two are almost mirror images of each other. And the most recent move up in interest rates has been directly driven by rising oil prices, which themselves have been driven by the escalation of the geopolitical tensions. Now, this isn't the first time this has happened over the last couple of years. Most of these spikes in oil prices have been driven by the geopolitical tensions, and so far all of them have been resolved to the downside. Now, could it be that the situation in the Middle East escalates further and ends up driving oil prices much higher this time around? Absolutely. I'm not going to try and tell you I can predict the future of the war in the Middle East. I can just tell you that right now, this looks nothing like 1973 because oil prices are trending lower, not higher. And it also looks nothing like the most recent oil shock from the Russian invasion of Ukraine. This right here was what oil was doing in the 3 months leading up to the invasion of Ukraine. Can you spot the difference? Oil prices were trending higher heading into the conflict as Russian troops were surrounding the Ukrainian territory and getting ready to invade. And we can use moving averages to help us stay objective regarding which direction price is heading in. All of the moving averages back here were pointing up. Today, that couldn't be further from the truth. All the moving averages are pointing down, and price for now is still below them. You could argue this is a bearish technical setup, and that's actually why we still have an ongoing short trade on oil on our website. So although you'll hear many news headlines comparing today to the 1970s, hopefully you now understand that the situation is quite a bit different. And when we look at inflation in the United States, we also see that it has been trending down violently. This is not the same look to the one we had in 2021 when inflation was picking up, which led to rising interest rates. And it's also not the same look to what we had in the 1970s with the 3 waves of inflation that led to higher interest rates. And given that interest rates tend to follow inflation over time, our expectation is that interest rates will trend lower here, not higher, assuming that we don't see any big war in the Middle East. Now, lower interest rates by themselves should be a net positive for the stock market, just like rising interest rates by themselves are a net negative for the stock market. And so far, that fits pretty nicely with the price action that we've had on the S&P 500 recently. Price recently broke out of this 3-month consolidation and is slowly grinding higher. All of the moving averages are pointing upwards, and we also have a very clean price channel that is very well defined by multiple market reactions, which for now still suggests that the S&P 500 is in a strong and healthy uptrend. We've made some incredible trades with our clients throughout this bull market. We send out buy and sell alerts on individual stocks, ETFs, crypto, and commodities. So far this year, we've been able to make some big winners while keeping our losses very limited. That is the key to becoming profitable in markets.